If you think the stock market is hitting record highs by accident, you're already making a massive mistake. Most people are staring at headlines, chasing fears, reading the wrong signals. But right now, there's a hidden engine driving this rally. And once you see it, you cannot unsee it.
Here's what usually happens for almost every retail investor. You see a geopolitical shock, a naval blockade, an energy spike, a war headline, and your gut says sell. You move to cash. Maybe you buy a hedge. You feel smart. You feel safe.
Then it happens. In 16 days flat, the S&P 500 erases a 9% drop and climbs past 7,000. Your screen is green, but you're in cash. You didn't just miss the move, you funded it for the people who knew what was actually happening. This isn't a failure of nerve, it's a failure of framework. You were playing a game of logic in a market that no longer runs on logic. It runs on something else entirely, and that's what we're going to show you today.
This rally isn't random. There is a specific three-pillared system holding this market up, even while the headlines scream chaos. And once you understand these three pillars, everything changes. Quick note before we start. Nothing in this video is financial advice. This is for educational and entertainment purposes only. Always do your own research and consult a licensed professional before making any investment decisions.
Pillar 1. Corporate fundamentals. Right in the middle of the Iran conflict, 83% of S&P companies reported earnings above expectations. Think about that. Wars, blockades, energy spikes, and 4 out of 5 major companies still beat their numbers? Why are earnings so strong? Partly because of what we're calling the One Big Beautiful Act, the 2025 tax legislation that effectively dropped $129 billion directly into corporate balance sheets. That's not a metaphor. That money had to go somewhere, and it went into buybacks, dividends, AI infrastructure, and hiring. That's a fundamental tailwind that no headline can erase.
Pillar 2. The AI industrial cycle. Here's something the energy bears always miss. Microsoft, Amazon, Meta, the biggest spenders in this market, are largely oil blind. Their data centers don't run on crude oil. Their server build-out plans don't pause because jet fuel costs more. When you have trillion-dollar companies locked into multi-year infrastructure cycles that are disconnected from energy prices, fear-based selling creates a gift. Think of it this way. Imagine there's a house fire across the street. Everyone runs outside, panics, starts calling 911. But the house you're standing in? It's built from reinforced steel with its own independent power grid. The chaos outside is real, but it has zero structural impact on your house. That's exactly what this market is doing. The fire is real. The panic is real. But the biggest stocks are made of reinforced steel right now. Pillar 3. Stealth liquidity. Every time fear spikes and retail sells, institutional capital steps in. The Fed's balance sheet management, while technically not QE, is releasing reserves into the system at a pace that functions like QE in practice. The result? Every dip gets bought before most people even notice the opportunity. So there they are, 3 pillars holding this market up. Bulletproof corporate earnings fueled by a $129 billion tax tailwind, an AI infrastructure cycle that's oil blind, and stealth liquidity that buys every fear-driven dip. This isn't luck. This isn't randomness. This is a structural setup. And the question isn't whether to believe it. The question is, are you positioned to benefit from it? Here's the reframe that changes everything. The market doesn't reward logic. It rewards positioning. It doesn't follow the news. It follows the money. And the money right now is flowing into an AI industrial cycle that runs on its own rails, largely independent of oil prices, largely independent of geopolitics. and absolutely fueled by structural tailwinds that won't disappear with the next headline. The market isn't irrational. It was never irrational. It's just been operating on a different information layer than the one most people are watching. You've been reading the weather report. Smart money is reading the tectonic shift underneath. So, what do you actually do with this? Here are two rules, not opinions, rules built on the structural logic we just walked through. Each one connects directly back to the three pillars. Rule number 1. Stop chasing cheap. Start chasing quality. Now, we already established in Pillar 2 that your AI megacap core belongs in your portfolio. That hasn't changed. Microsoft, Amazon, Meta, Google, Nvidia, those are quality. Oil-blind, structurally backed, locked into a multi-year infrastructure cycle. That's the definition of quality. You are keeping those. The problem is what people are putting around their AI core. The small cap AI adjacent names, the speculative plays with no earnings, no moat, and no structural reason to exist beyond the headline. Cheap stocks that are cheap for a reason stay cheap. They aren't undiscovered gems. They are value traps dressed up in AI language. And right now they are bleeding portfolios dry, while the AI core they sit next to keeps climbing. So what fills those empty slots? Specifically, financials and healthcare. Not because they are exciting. They are not. But because right now the structure favors them. Banks earn more on every dollar deployed in a high-rate environment. Their margins expand while everyone else complains about borrowing costs. Healthcare demand is rate insensitive. People do not stop getting sick because the Fed raised rates. And demographics only move in one direction. Structure beats excitement every single time. Rule number 2. Use the income gap. Stop praying for direction. Start getting paid for patience. Now, I know what you are thinking. If earnings are this strong and liquidity is this powerful, why are we even talking about caution? Here is the honest answer. We are living in two realities at the exact same time. The economic reality is genuinely strong earnings, tax tailwinds, AI infrastructure. But the valuation reality is genuinely stretched. A CAPE ratio of 40.1 means this market is priced for everything to go right. Not some things, everything. Smart money doesn't pick one reality and ignore the other. Smart money navigates both. And that is exactly what Rule 2 gives you the tools to do. Think of this market as a high-performance sports car doing 150 miles per hour. The engine is incredible. Earnings beats, tax tailwinds, AI infrastructure. The fuel is high octane, stealth liquidity, institutional buying. It is a beautiful, powerful machine. But here is the thing about going 150 miles per hour. Even a small pebble on the road, one bad inflation print, one Fed surprise can cause a skid. The car is not broken. It is not about to explode. It is just going very, very fast. We are not stopping the car. We are putting on a seatbelt. So what is the seatbelt made of? Two things: dividend growth stocks and covered calls. Put both tools together, and here is what you have built: a buffer zone. 3 roads ahead of you, and you win on all 3. Road 1, the market keeps climbing. Your quality stocks go up, your dividend keeps growing, and your covered call either delivers a profit or gets rolled forward. You participate in the upside. Road 2, the market goes sideways. Most investors hate sideways. You love it. Your dividend income and covered call premium keep arriving every month like clockwork. You are getting paid to wait. Road 3, the market corrects. Your quality positions hold better than speculative names because structure holds. Your dividend income keeps coming. Your covered call premium cushions the dip. The buffer zone absorbs the hit. This is not passive investing. This is precision driving. At this point, something might shift for you. And it's not a strategy shift. It's an identity shift. You're not bad at investing. You never were. You've just been playing checkers while the market was playing 3D chess, and nobody handed you the rule book for the new game. The investor who reads the news and reacts, that's the old you. The strategist who sees the $129 billion tax tailwind before it shows up in earnings, who recognizes stealth liquidity before the chart confirms it, who owns the pipes while everyone panics about oil prices, that's the version of you that actually wins. You're not chasing candles anymore. You're reading what's underneath them. So the next time you see a naval blockade, the next time there's a geopolitical crisis and the market dips 3, 4, 5%, you'll know exactly what you're looking at. Not randomness, not irrationality, a shakeout, stealth liquidity moving in. The same 3-pillar cycle running again. You'll see the bear trap before you step in it. In the next video, I'm going to show you the specific chart setups where institutions trapped retail during that last 9% dip, and exactly where the stealth liquidity footprint showed up before the recovery. If you want to see the real institutional playbook, that's where we go next. And if you want to keep thinking like a precision driver instead of reacting like the crowd, that's exactly what this channel is built for. Subscribe so you don't miss the next one.